Welcome back to the Investor Professor podcast. This is Dr. Ryan Peckham, and this is episode 45, our one-year anniversary tribute show. Man, I really should have invested in some sound effects, a kazoo, something. But on this episode, we're going to talk about some of the numbers that we've done the first year of having this podcast, and we're also going to talk about inflation, the stock market, what's going on, what you can do to help protect yourself. Is there anywhere to hide? We will discuss all this, but as we do it here, let's get to work. Okay, well, as I said in the intro, this is our one-year anniversary show, and put out a little video, but I wanted to thank you for listening to this podcast, whether you've listened to one or if you've listened to all of them. I appreciate the time that you've given me to help share some knowledge and hopefully make you better as an investor. So I just wanted to share some of the stats with you of how this podcast has grown. We've had over 5,000 downloads, which seems pretty incredible. That's an average of like 113 per episode, which is a lot better from where we started. It's pretty incredible. I'm still saddened by the fact that, I think one of the most listened to episodes is still episode number 1, where I was really, the first couple are to me really hard to listen to. But you got to be willing to put yourself out there, and it takes a while to become comfortable. So some of the things the stats that I find pretty interesting, and these come from Spreaker, from Spotify. If I was better, I could pull stats from Apple, but for some reason, it's just beyond me. Like, their website is so hard to use. Spotify's is so much easier, but it's pretty neat how it breaks it down. And I've done this in a couple episodes, but on Spotify, our fourth largest audience of downloads comes from Australia, which is pretty crazy. We've hit, I think, 17 different countries on Spotify. And then it also tells you what people are listening to. So the top artists in the last month of people who have downloaded this podcast on Spotify, the top artists they listen to are Taylor Swift, the Chainsmokers, Kid Laroi, Eric Church, Eminem. And if you don't know who some of these people are, don't feel bad. I had to look some of them up too. So Kid Laroi sounds a lot like Post Malone. You can DM me. We can fight about that if you want. So, but looking at this, and then on Listen Notes, you can go find us on there. We're now in the top 10, still in the top 10 most listened to podcasts, or top 10% most listened to podcasts in the world, which is pretty crazy when you factor in that there's 2.8 million podcasts. So, we'll see if we can get that up this year. But I do appreciate all the time and the feedback that you've given. Our Instagram page is growing like crazy. I mean, every single time we log in, there's more people following the page. So we really do appreciate that. And then also leaving us comments and notes and ranking the podcast or liking it on Apple Podcasts and actually leaving a review, even if it's just clicking the number of stars, helps tremendously too. So it feeds the algorithm, if you will. So if you haven't done that, please consider doing that for us. All right, so let's talk about the stock market. This has been a fun year, hasn't it? Oh my gosh, this has been a tough year. And when I say it's been a tough year, I mean like it's been a historically tough year in the investment world. So the stock market is off to its worst start since 1970. And don't worry, I have a stat that's going to be even better than that one. But when you look at the market here, and you look at the NASDAQ, and when I say the market, that's the S&P 500. Currently, right now, it's down 13.5% for the year. You look at the NASDAQ, it's down 22.37% for the year. And April was the worst month for the NASDAQ since 2008. So it was actually worse than 2020 for the NASDAQ. And if you'll remember, the NASDAQ is the index that holds mainly technology stocks. And so when you look around, it's kind of like, where do I hide? And you could say to yourself, oh, well, I should be in bonds. Well, actually, bonds are they're just getting absolutely crushed. So for the year, long-term treasury bonds are down 18%, which is unheard of. Normally you hear, hey, I should buy bonds. They do well when the stock market's volatile. And that's a place I can kind of hide out, right, is in bonds. This is actually the worst start for the year for the bond market since 1842. 1842, people. So, that is pretty rough company when you're setting 100-year records on bad. And so, what do? And this goes back to inflation is, it's so scary because it takes from everybody, right? It takes from everybody. It takes from every sector. You look at the different sectors, and obviously energy's been kind of the place to be this year. There's a couple reasons for that. But obviously Ukraine and Russia is one of the big reasons for that. And then also utilities, which would be something like Consolidated Edison, which I believe we've talked about on the show. And then you have consumer staples, which are things that, individuals have to buy. That would be companies like Procter & Gamble, Johnson & Johnson, Coca-Cola, Pepsi. Don't forget, Pepsi also owns Frito-Lay, so that helps them out as well. But these are things they're called staples because, people have to buy those whether times are good or bad. And so when you look at the sectors that have been beat up, it would be like consumer discretionary, which are, things you buy based on how your income's doing. If you're doing a little bit better, you might buy some more things in that category. So understanding what category your stocks are in makes a big difference. And also utilities, it shouldn't be that hard to figure out, but utilities work well because, you're going to have to pay your light bill and you're going to have to pay your electric bill and, you're going to have to keep all of those things going. So your money is going to have to go to those sectors, whether you like it or not. And so you see this kind of move from the riskier tech stocks, the stay-at-home stocks, if you will, that we had during the pandemic. You look at some of them that we've highlighted, Peloton. My gosh, you look at Teladoc and how ugly that thing is. Teladoc, their symbol is TDOC. And they actually went public 5 years ago, July 2017, for $34.70. They hit a high on January 1st of $263, and now they're all the way back down to $33. So they're below their IPO price. And they have a lot more people on the platform than they did when they started, but they're just losing money like crazy. Their earnings per share are just very, very negative. And so when you look at a market like this, the last couple years, there was this euphoria in the market of, okay, this company isn't profitable, but they're going to be. This company isn't profitable, but look at their sales. And we kind of went away from, or I'm not saying we did, but the market went away from, what are some of the normal ways that you value a company? Earnings per share, PE ratio, right? Price to earnings ratio, which has been one of my main constant ways to value companies. But analysts went away from that. They said, nah, the PE ratio is old. We're going to do price to sales. And the reason they did that is because if you don't have any earnings, you don't have a PE ratio. The PE ratio is the price of the stock over your earnings. So if you don't have any earnings, you can't use a PE ratio. So they had to start coming up with something else to be able to value these companies. And so now that's gone away, and the companies that have done the best during this trying time are companies that actually, make things that people are going to need, and they do it at a profit. And so you're seeing this compression of these, these numbers that companies have. You're seeing a compression of that, and that's why the reset, if you will, has been so violent for so many companies. I said numbers, but I really mean like their valuation. Their valuation has become compressed, and the reason for that, one of the main reasons, is that when you look at the 10-year Treasury, it's been constantly going up this year, right? 10-year Treasury's been going up. And this is going to get a little out there, so I hope you can stay with me. So the 10-year Treasury goes up. It now crossed 3% this week, which is why you saw the violent turnaround on Thursday. And you saw the market drop so much on Thursday. So 1,000 points. The market came down. And that's because the 10-year Treasury went above 3% for the first time since 2018. And back in 2018, it actually peaked at 3.26%. So we'll see if we get close to that. But go back and look at stock charts from 2018, and you'll notice that the NASDAQ dropped 22% that month as well. And so what ends up happening is that there becomes, like, the 10-year Treasury is considered a risk-free return. So you can make 3% on your money just buying U.S. Treasuries. And so why take the risk in owning a stock or certain stocks when there's this risk-free rate out there? So it becomes competition. And the part that loses people is that when you're looking at a company that you're looking at their profits in the future, if interest rates are higher, that makes those profits in the future worth less. It's time value of money. And I know a lot of my former students are like, oh God, not this again. But it really makes a big difference. And so if you're going to invest in companies, you have to make sure that they're actually earning a profit, because if they're not supposed to be profitable for 3 to 4 years, well, then they're just going to get crushed today, because those profits 3 to 4 years in the future are not going to be worth as much because interest rates are going up. And so we'll see if, we can get some. If inflation has peaked, if we start getting numbers where maybe some parts of inflation have started to come down, that will be key to helping the market do better. And so, my advice to you is to invest in companies. It's not to sit on the sidelines. It's to invest in companies that, are maybe, people are going to use, they're going to have to use them, but also invest in companies that you're going to be paid to wait for the market to get better. So what do I mean by that? Well, there's 2 ways a company can pay you, right? The easiest one is a dividend. And then the second is that they can buy back their own shares and do a share repurchase. Well, getting paid a great dividend allows you to be able to sit there, watch your share count go up. And also, if you invest in good, solid companies, they have a history of raising those dividends. And I know I've talked about this before, but I think it's a very good reminder for you that investing in companies that pay you to wait will allow you to have the patience to persevere through a bad market. And I'm definitely not saying go out and just buy a bunch of stuff, but you can just ease in and start looking at your share count more than what the value of your portfolio is. Because I'm telling you, nobody likes to look at themselves lose money every day. They don't. And we've talked about investment biases before. It's called myopic risk aversion, which means the more often you look at your portfolio, the riskier it's going to appear to you. But just start looking and saying, hey, do I have $300 to buy 5 shares of Coca-Cola? Can I add to my, whatever the stock is, but, make sure it's something that is a company that's profitable, has earnings per share, and is going to either be doing a share buyback or is going to be paying you a dividend. Now, I want to give you an example of how powerful share buybacks can be. And a lot of these companies that have already reported have discussed the share buyback programs that they're doing, right? So for example, Apple announced that they're going to buy back $90 billion worth of stock. I mean, it's tremendous. I mean, Apple is like the number one company that buys their own shares back. So the difference between Apple buying shares back at 180 or 150, the stock is currently at, 157.28. So the difference between Apple buying their own shares back at 180 versus 150 is pretty tremendous. So if Apple were to buy back those shares at $180 a share, they would be able to buy back 500 million shares, and they take that off the table, right? But if they're buying them at 150, they're able to buy back 600 million shares. So 20% more. And if they buy back 600 million at $150 a share, that reduces their share count by 3.75%. And so when a company does this, they remove those shares from the market. And so every share that's left outstanding is going to have a larger piece of the earnings per share that they're able to generate. And so it makes a tremendous difference over time. And that's the key, is the over time piece. And so it's hard to know these things intellectually when emotionally, you're getting punched in the face every day watching the market drop. Like, it is painful. And, you can go back and look at a stock chart, and this happens with students all the time. We go back and look at a stock chart, and you see it drop, and then you see it come back up, and people go, oh, that's not that bad. And I go, well, when you're going through it, it's pretty rough. When you look back at it on a stock chart, it doesn't seem that bad, but when you go through it, it's pretty rough. And so for somebody, my age, I don't know how, but I'm like hitting all these. I remember the 2000 bubble bursting, the tech bubble bursting. I was in college. I remember driving through Austin, Texas, and this is when the first tech drop, and you had all they called them Dellionaires from the company Dell, and you drive past these parking lots of like grocery stores, and there were Ferraris and Lamborghinis for sale. Not fun. I knew people who lost their parents, their parents had invested it. They lost their college fund. I mean, not good. Fast forward 2008. Massive correction. Actually, that's when I started my business. Not the best time. And then 2020. And so, it just seems like they're coming faster and faster. But you have to be willing to come out on the other side. And so the other one I'll give you an example of is Google, which I think is probably one of the sneakiest, best buybacks that is out there today. And so Google announced that they're going to buy back $70 billion worth of stock. And they announced that they're going to be doing a 20-for-1 stock split, and that's coming up in the next 2 months. And so when you look at that, obviously their share count's going to change. But right now, Google has 300 million shares outstanding. And so when you look at the difference, I thought they would be closer to 3,000 when they split, and now they're at 2,300. And so the difference in that is, with that kind of buyback, with that kind of money, Google today, with their current share price, could buy back 30 million shares versus 23 million if they were at $3,000 a share. And so when these companies split, when Google splits, when Amazon splits, Amazon's going to be doing a $10 billion buyback. When these companies split and they drop from 2,300 to 120, it's going to be a great opportunity for a lot of you to buy into Google or Amazon, companies you've probably wanted to own, and Amazon's down 40% from its high. And do they have some problems? Yes, they need to get their expenses under control. Obviously, when you're delivering as many packages as they do, and oil goes up and deliveries now cost more and all that, it becomes an issue. But Amazon has really spent a lot of money figuring this out and figuring out how to manage it. There's just a little bit of a delay. And so, you have to, I think in episode 1, I talked about what kind of portfolio do you want to own? What are the names you want to own? You have to look at that list and say, okay, which one of these have been beaten up and how do I buy into some of this? You have to be willing to walk into the fire a little bit and be willing to keep going. So I tell you that because it's important, and we all kind of need to hear that over and over again and remind ourselves that, times will get better. I wish I could say it'd be this coming week, but I'd probably be wrong. One of the things, though, when you look at some of the market indicators that I look at to try to figure out, okay, when is the selling pressure going to maybe lessen, is every day they look at, when you're looking at the stock market, there's so many sells, there's so many buys. And so when you look at on a really bad day, how much selling pressure there is, when you have more than 90% of the orders are sells, that usually kind of indicates that we could be getting close to capitulation where, people throw their hands up and say, okay, I'm not doing this anymore. And, whoever's left is whoever's left. Well, Thursday, when the market dropped 1,000 points, there were 95% of the orders were sell orders. And so if you're looking at building your portfolio, this could be a good time to start, just nibbling on certain stocks that you want to buy. Like this past week, I bought Microsoft, I bought Apple, I bought, a lot of the companies that we discuss, because I know that is, even though emotionally it might be hard to do that, intellectually I know this is the right path. And whether it's 5 shares, 10 shares, 1 share, whatever it is, you got to be willing to, on good companies, again, I say it over and over and over again, you got to be willing to step in there a little bit and kind of start the process. Because 2 years from now, 3 years from now, if you're a long-term investor, these are the moments that are going to make you money 2 to 3 years from now. Like this is the time that when things recover and things start doing better, the decisions you make this year, when it's painful, are going to be the harvest that you have later on, if you will. And so you have to keep reminding yourself of that because it is hard. It's hard to, invest when every single day you look at it and go, oh, well, that was dumb, me buying yesterday. If I would have just waited till today, I would have done better. Also, the number one investment you're going to make is yourself. And so the best way to fight inflation is to invest in yourself, find a better job, make yourself more valuable. You have to be able to make more money in order to compensate for inflation. So whatever you're doing, whatever you're reading, making yourself more valuable, looking for another position, you have to take that seriously. I've talked to a lot of people and it's like, man, if you don't like your job, has there ever been a time that's better than today to go look for another one? Like, I really don't think so, right? The great resignation, as they call it. So, bet on yourself and invest in yourself and do something where, you can make yourself more valuable. Also, the market gives you, there's weird things happening out there. And here's one of them. So Twitter, right? We've talked about Elon Musk and we've talked about him taking over Twitter. What price is he taking Twitter private at, right? Or what price did he say he's going to buy it for? $54.20. And where is Twitter trading today? $49.80. So almost, not quite, but almost $5 below. So why? Shouldn't it be trading for $54.20? Well, there must be somebody, there's some investors who think maybe the deal won't go through. Maybe they think the regulators will block it. Whatever the reason is, if you think that Elon will eventually buy Twitter and that he will take it private, you can buy the shares today for $49.80, and he will buy them from you in the next couple months at $54.20. So it's an easy way for you to make some money if you really do think that the deal is going to go through. And so, when you have this kind of selling and everybody's just selling everything and they're selling mutual funds and they're selling their ETFs, their exchange traded funds, all the good stuff gets thrown out with all the bad stuff. And then the professional money managers are going to go in there and they're going to cherry pick the good companies. They're going to cherry pick Apple and Google and Microsoft and whatever's out there that's been really beat up that they know are really good, solid companies, because time and time again, it's been proven that those are the companies that come back the fastest when times get better. So, stretch out your time horizon, think further than 5 weeks ahead, 5 months ahead. Think further out than that, and be brave and go invest in something that you've been wanting to own. I don't know if I said this on a previous podcast or not, but normally, if you go back to 1901, the most volatile period of a presidency is the 6 months that lead up to the midterms. So great, we have that to look forward to as well. But the best 6 months, stock market wise, for a presidency tend to be the 6 months after the midterms. So, we're probably going to have a long, drawn out summer, more volatility ahead. But as we get closer to the end of the year, maybe things will kind of be recalibrated enough that you can dip your toe in the water. So, anyways, final thoughts here. I really do appreciate you listening. I appreciate all the feedback that y'all have given as far as topics that you want me to cover. I have a list of those, and I will be bringing those up in future episodes. There's been some people have submitted interviews that they've wanted to hear, and so I will reach out to some people, see if I can't get somebody on the different topics to have them on as well. Those have done extremely well, and I just want you to know I sincerely appreciate you taking the time to listen to this, but also a lot of y'all have shared this with other people that you think will find it valuable. And that to me is the best compliment that anybody can give. So I appreciate you. Thank you again. I hope you have a great week, and I'll see you next time.